Welcome, Curious Minds, to The Deep Dive. Today we're jumping into the recent fiscal fourth quarter and full year 2025 earnings call from RPM International. You know, the company is kind of a silent giant behind so many products we see or maybe don't see. Industrial, commercial, even consumer coatings and sealants. Think about rust-proofing spray in the garage, or maybe heavy-duty stuff on bridges and factories. Our mission today is really to cut through the usual earnings call noise, pull out the critical insights, and, understand what's really driving their performance. And maybe more importantly, what it all means for where they're headed. This isn't just about the numbers themselves. It's about strategy, market dynamics, and how a big global player navigates what feels like a low-growth, no-growth world these days. Okay, let's unpack this. So maybe let's kick things off with the big picture, because RPM just wrapped up a fiscal year hitting record numbers pretty much across the board. Record sales, record adjusted EBIT, and record adjusted EPS. And their fourth quarter, an absolute standout. Same records again. Sales, adjusted EBIT, adjusted EPS. Now, this isn't just a one-off thing, is it? We're talking about a pretty impressive run here. Record adjusted EBIT in 13 of the last 14 quarters. That kind of consistency, well, it really makes you pay attention.
It really does. Yeah, what's fascinating here is that even though management themselves called it a mixed economic environment, and usually that's code for trouble, RPM has just consistently delivered. Their performance wasn't, accidental. It was driven by solid, positive volumes, especially in those higher margin areas like systems and turnkey solutions for high-performance buildings. Think specialized coatings, sealant systems for things like data centers maybe, or advanced flooring for factories, big projects. They've also kept a sharp focus on maintenance and repair work. M&R tends to be more resilient when the economy slows down, right? And critically, all four segments saw adjusted EBIT go up. EBIT, earnings before interest and taxes, that's your core operational profit measure. Their construction products group, CPG, and the Performance Coatings Group, PCG, those showed the biggest gains. Actually, 3 of their 4 segments hit record adjusted EBIT just for Q4. Pretty strong finish.
And that consistent success, you mentioned it wasn't accidental, ties back to their MAP 2025 program, right? Their operating improvement initiative. That officially wrapped up May 31st, 2025, and the impact sounds, pretty significant. So what did this program actually do for their, operational efficiency? How did it fundamentally change things at RPM?
Yeah. MAP 2025. If we connect this to the bigger picture, it's been nothing short of a game changer for them. Think of it less like just cutting costs and more like a complete overhaul of their financial engine. Since fiscal 2022, they've pushed their gross margins up significantly. They're getting close to that ambitious 42% goal they set. That means they're just keeping more profit from every dollar of sales. Pretty straightforward. Their adjusted EBIT margin, up by a really remarkable 260 basis points. That's 2.6 percentage points. A huge boost in profitability from their core operations. And here's a critical one. Working capital as a percentage of sales saw a 320 basis point improvement. Now, for anyone maybe not familiar, working capital is basically the cash tied up in day-to-day operations. Inventory, receivables, payables. Improving that means they're managing their short-term cash flows much, much more efficiently, not letting cash just sit around unnecessarily.
So essentially, they're squeezing more cash out of the business itself without necessarily needing massive sales growth.
Exactly right. These efficiencies directly strengthen their cash flow. It gave them this powerful internal source of funding, and that enabled them to complete their largest year of acquisitions in company history, fiscal 2025. What's maybe even more impressive is they did this while keeping a really strong balance sheet. Their credit metrics are near all-time bests. So it tells you they're growing smart, strategically, without wrecking their financial health. That's so important in a volatile economy.
That is incredibly impressive, turning those internal improvements into, firepower for big M&A deals. And clearly they're not stopping there. They're making another big move, a shift in their whole operating structure, moving from 4 segments down to a new, streamlined 3-segment model: construction products, performance coatings, and consumer. Okay, this is where it gets really interesting for me. What's the deep thinking behind this reorg? Is it just about cutting more costs, or is there a bigger strategic play here?
That's a really important question. It's definitely about accelerating growth. The idea is to build on the efficiencies they've already ingrained from MAP 2025, and then directly leverage them for growth, both organic growth growing from within and inorganic, through more smart acquisitions. So for example, businesses that used to be in their old specialty products group, they're being absorbed into this new structure. You've got the industrial coatings businesses like Carbaleen moving into performance coatings. The goal there seems to be fostering better collaboration, developing high-performance coatings together, improving distribution, making them sort of more unified for those big industrial clients.
We're breaking down silos, basically.
Yeah, precisely. Yeah. And then you have the DayGlo color business, the super bright fluorescent colors. That's joining the consumer group, which is fascinating because Rust-Oleum, one of RPM's big consumer brands, is actually DayGlo's biggest customer. So bringing DayGlo into the consumer group lets them benefit from insourcing, maybe making more internally, and they can directly leverage Rust-Oleum's marketing muscle. Now, look, it's not just about cost savings, though they do expect about $15 million in SG&A streamlining from this in Q1. SG&A being sales, general, and admin expenses, overhead basically. But the bigger play, I think, is driving collaboration, creating real synergy, and hopefully generating new business down the line. It's about being more nimble.
Okay, so structure changes to drive synergy.
Yeah.
But beyond that, what are their actual plans for accelerating growth, especially when everyone's talking about this low to no growth environment? And what's the outlook for fiscal 26? Are they still aiming high?
Well, absolutely. Management is definitely anticipating another record year for sales and adjusted EBIT in fiscal 2026. They're projecting sales to increase low to mid-single digits, and adjusted EBIT, they expect that to grow even faster, high single to low double-digit range. So leverage there. Part of that positive outlook includes about $70 million in sort of carryover benefits from M8 2025 still flowing into FY26. That shows you how lasting those changes were. They seem to be really doubling down on what they can actually control. More efficiency initiatives, yes, but also expanding those high-margin turnkey and system solutions, especially for high-performance buildings. They also expect to generate a solid 2 to 3% organic growth for the year. That's growth from existing businesses, not just buying companies.
Okay, that sounds positive, but I mean, no business lives in a bubble, right? What headwinds are they facing? What challenges are they navigating? I'm particularly curious about those tariffs everyone's worried about and the state of the consumer market. That seems tough.
Yeah, that's a crucial point. And they were pretty open about it on the call. The company acknowledged persistent tariff uncertainty, specifically thinking about imports from China. They estimate it could be a negative 4% to 5% hit to their top line in fiscal 26 if they can't mitigate it somehow. That's a significant potential headwind they're actively planning for. They're also definitely grappling with raw material inflation. It's hitting certain areas harder than others. For instance, metal packaging, propellants, pigments. Those are really weighing on the consumer group. While things like epoxy resins, those are a challenge for their industrial businesses. Prices up low double digits there. For Q1 specifically, they're forecasting maybe a 1 to 2% consolidated inflation, but the consumer side gets hit much harder. Metal packaging up 11-12%, propellants 13-14%, pigments 10%. That's tough.
Wow, yeah. That's a serious squeeze on the consumer side margins.
It is. And then you got elevated interest rates, still a headwind, putting pressure on existing home sales, which in turn pressures DIY activity. People just don't renovate as much when they are moving. Their DIY consumer business has faced, I think they said, an unprecedented 24 months of flat or even negative growth, largely due to this 40-year low in housing turnover. But RPM isn't just sitting there. They're strategically buying raw materials ahead of time to try and mitigate future tariff hits. They're implementing targeted price increases where the market allows. And they're aggressively diversifying their channels through acquisitions, like the pink stuff, that cleaning product that's blown up. That acquisition isn't just a new product line. It opens up totally new channels for them. Grocery stores, discount stores, drugstores. It shifts reliance away from just the big box home improvement stores. So this whole deep dive, essentially, it offers some really crucial signals for investors or really anyone trying to understand resilient business models in tough times. Their continued ability to generate strong cash flow, operating cash flow for fiscal 25 was $768 million, their second highest ever. That's impressive. Especially impressive when you consider they took on about $520 million in debt for those big acquisitions. It really underscores the quality of those operational improvements. It shows they can buy growth without totally over-leveraging themselves. And their investments in growth projects, new facilities in Belgium, India, consolidating 8 older plants while opening 3 brand new ones, that shows a really proactive stance on capacity and global reach. Looking ahead, their CapEx, capital expenditures, money spent on buildings, equipment is planned to be between $220 and $240 million for FY26. Even after accounting for things like depreciation and interest costs, that level of investment signals real long-term confidence.
It definitely sounds like a company that's constantly building for the future, not just, managing the present quarter. And that pivot you mentioned, from mostly cost-cutting with MAP to this new growth acceleration phase, backed by data analytics for deciding where to invest capital, that really signals a more mature, more dynamic business model, doesn't it? The focus on high margin systems, that asset maintainer approach in construction and performance coatings, rather than just selling, cans of paint, that seems like a significant competitive edge. Like, instead of just selling paint, they're providing the whole coating system and the expertise to protect a bridge for decades. Or specialized flooring for a hospital. That's got to be appealing when finding skilled labor is tough. Companies want turnkey solutions. They mentioned their fiberglass business, for example, seeing double-digit growth because data centers need non-conductive materials. That's a direct benefit. And their M&A strategy seems to fit right in, looking for bigger deals in related areas, like cleaners. The pink stuff brings in, an estimated $150 million a year. Another one, Ready Seal, adds $40 million. That significantly boosts their cleaning products presence to over $250 million now. It shows they're willing to expand beyond just traditional bolt-ons, but they still have this pipeline of smaller deals that fit that system selling strategy.
Absolutely. And despite the ongoing inflation, those tariff headwinds we talked about, management's confidence really comes through. They're sticking to their goal of achieving a 16% EBIT margin over the next 2 to 3 years. Maybe not in FY26 itself, but soon after. That suggests there's still significant untapped operational leverage. The potential for profit growth to really outpace revenue growth once they hit certain efficiency levels, which of course raises the big question for us and for you listening. Can they sustain this growth momentum, especially with that consumer DIY market still looking so challenged? Or will these strategic investments, these smart acquisitions like Pink Stuff, will they truly provide the diversification and the new channels needed for, meaningful growth in that segment too? That consumer piece really feels like the key variable looking forward.
Yeah, this is the part where we put on our imaginary hedge fund hats for a moment. Brainstorm something a little wild maybe, but plausible based on everything we've just unpacked. If you're looking at RPM purely from a strategic market angle, here's a thought we kicked around.
Okay, yeah. So considering RPM's really consistent outperformance and their clear strategic doubling down on construction products and performance coatings, driven by those high-value systems, the developing world expansion, strong backlogs, while at the same time their consumer group keeps grappling with what management themselves called unprecedented DIY softness and that raw material inflation, you might consider a long position in RPM, specifically targeting the sustained leverage and growth you expect from the industrial and commercial sides of the business. Then maybe, to hedge against that persistent drag from the consumer market, you could pair that trade. Simultaneously, take a short position in, say, a carefully chosen basket of pure-play consumer DIY paint and coatings companies. Companies that lack RPM's diversification into turnkey solutions or their strong international growth platforms. The thesis essentially is that RPM's strategic pivot toward its industrial and commercial strengths will create this widening gap in performance, making their industrial side a much bigger driver of overall value, even if the consumer segment continues to be a drag on their less diversified peers. Just a thought experiment, of course.
Right. So just to recap everything, RPM International is showing some impressive resilience, some real strategic agility here. They've not only turned those MAP 2025 efficiencies into record financials and a strong balance sheet, but those same efficiencies also funded their biggest year ever for M&A. The new 3-segment structure, it isn't just shuffling boxes. It seems designed to genuinely accelerate growth and collaboration, even while they're navigating some pretty significant headwinds, tariffs, inflation, and that really tough consumer DIY slump.
Yeah, their laser focus on high-performance building solutions and that more deliberate, data-driven way they're allocating capital, it signals a company that's really evolving to meet market demands head-on. Challenges definitely remain, especially volatile input costs, that stubborn DIY environment, no doubt about it. But management's confidence, their stated goal of hitting 2-3% organic growth and continuing to expand margins, it speaks volumes. It points to the enduring power of their strategy. And they're already planning the next phase, mentioning a new 3-year program to be unveiled next spring or summer. They're not standing still.
So what stands out most to you from this deep dive into RPM is that strategic pivot, especially bringing in brands like the Pink Stuff. Is that truly enough to offset a longer downturn in consumer DIY? Or will their new channels, their focus on high-value industrial solutions, will that eventually pull the whole company forward regardless? It's definitely a fascinating case study in how a major player adapts and maybe even thrives in this kind of mixed, uncertain economic environment. Thank you for joining us for this deep dive.